Good morning, everyone, and welcome. I'm Jackson Ewing. I'm the Director of Energy and Climate Policy here at the Duke University Nicholas Institute. We really appreciate you joining us for this webinar, Power Sector Mergers and Competitiveness. We're entering a period of significant challenge for the utility industry players, as well as a period of significant opportunity. We all on this call know that electricity demand is growing, driven primarily by data centers, but also by manufacturing, electrification, broader economic growth, and so on. And utilities are responding with some of the largest infrastructure investments this century. It's against this backdrop that utility consolidation is becoming more important. And today we're going to consider two very different but significant transactions in the Southeast U.S. utility sector. The combination first of the Duke Energy Carolinas and Duke Energy Progress merger will unify Duke's electric utility operations across the Carolinas, which have operated as separate regulated utilities since the 2012 merger between Progress and Duke. The combination there has now received approvals and is targeted to take effect at the beginning of 2027. Duke argues that operating as a single utility is going to reduce costs, increase efficiencies, improve planning, reduce complexities around IRPs and beyond, and projects a customer savings of roughly $2.3 billion through 2040, a claim that we will interrogate. The proposed combination of NextEra Energy and Dominion Energy is much larger in scope. It would create the nation's largest regulated electric utility business, serving roughly 10 million customers across 4 states. Unlike Duke, this transaction is in progress, and federal and state regulatory approval still ahead. And so we will look at what the potential implications of that merger would be as well. Tying these things together is a central question along the lines of what this greater scale can mean for outcomes, for customers, and for the power system as a whole. Vitally, whether regulators have the tools and leverage that they need to ensure that espoused benefits are actually realized. There are a number of inflection points here. How will regulators evaluate the promised customer savings? How consolidation can affect investments, the ability to meet that growing demand? How greater scale affects accountability, regulatory leverage, and affects the asymmetry that sometimes exists between the utilities and the regulators themselves. What, more broadly, consolidation signals about the future of competitiveness in the regional and U.S. power sector is where we will land the discussion today and present some of the expansions to the competitiveness work that we've been doing here at Duke. So we're going to start this exploration of these questions in conversation, with Maggie Shober. She's the research director at the Southern Alliance for Clean Energy. Our Nicholas Institute team will then share analyses on the record of utility mergers past and present, and updates from the Southeast Power Sector Competitiveness Dashboard, which I referenced just a moment ago. We're not going to have a dedicated Q&A session, so please voice any questions or comments you have in the Q&A function at any time. I'll push as many of these as possible to our speakers in real time. I will be your interrupter in chief and do my best there. So with that, Maggie, let's get into it. I want to start with the Duke Energy, Carolinas Duke Energy Progress merger, and a Duke's argument, which I just kind of did a poor but basic job of introducing in my comments, is that the merger is largely about eliminating some corporate duplication, capturing efficiencies, so on and so forth. Who could disagree that those are good things? So what are your and your organization's concerns about that transaction? What do you think regulators should require to ensure promised efficiencies actually flow to customers? How are you viewing it overall?
Yes, thank you. So first, thank you for tackling this very timely discussion. Just for full transparency, Southern Alliance for Clean Energy, or SACE, my organization, was an intervener in the case. So we looked at it really closely, and this Duke Energy Carolinas, Duke Energy Progress, DEC, DEP, as we call them, combination has is actually sort of the second step in a merger that actually happened in 2012 when Duke Energy bought Progress. So the same holding company has owned these two electric utilities, but they have been operating as separate utilities since that time. And I see it as, the sort of efficiencies that are either real or claimed. There's real sort of physics-based efficiencies when you're operating an electric grid to operating it over a larger, geographic area, especially if you are planning over that, planning your transmission and generation across a broader area. And there are kind of two ways to achieve that geographic diversity that we've seen. One, here in the Southeast, and one kind of pretty much everywhere else. They have wholesale markets and a lot of times, regional transmission organizations that do at least transmission planning, cooperatively, if not also some sort of mechanism for, generation planning. In the Southeast, we do not have those wholesale market constructs. And so the way to expand geographic area is primarily through these business consolidations that we're seeing. And so, for instance, Duke, which has operated these two electric utilities, both of which operate in North and South Carolina, has had to have, separate rate structures, separate reserve margins, separate dispatch for each of these utilities. And the rate structures themselves are even different between North and South Carolina for each of the two entities. So it's pretty complicated, to say the least. There's certainly the potential for efficiencies when you are combining those, especially when we're saying let's have one reserve margin for both of these utilities that are interconnected right next to each other and owned by the same parent company. I think the second part of your question too is actually really key, which is we know there are efficiencies. How do we ensure that the benefits from those efficiencies actually flow to customers? Utility rate making in particular is a very complicated business, and so making sure that any sort of benefits, can flow to customers is something that is discussed a lot in these merger dockets, but not always brought back up in the future. So, we are the SACE, Southern Alliance for Clean Energy, was a party to a settlement in that docket that did include what we see as a potential solution to that, although not all of the kinks were worked out, if you will, which is that there's a couple different things. There is a plan for Duke to report back on benefit metrics to the commission over the course of the next 14 years. And at that point, if the benefits do not match, what they were intended to, the commission can order Duke to have shareholder funds actually replace that, as long as there aren't any sort of unforeseen things that come up that reduce those benefits. So that's a pretty big, potential if. So I think that a fair amount of uncertainty remains, although it is in theory a pretty good construct to try and ensure that at least in theory, benefits captured by this business combination can make it back to regulators.
Yeah, thanks, Maggie. We're going to hear from my colleague Ben later about this final point that you made about the ambiguity that sometimes exists after the fact about these consumer benefits and some of the lack of clarity around the follow through for that and what the actual outcomes are. Ben will give intelligent analysis of that. I'll just say from the sidelines of that work, it's striking how little clarity there has been in some of the past merger instances. So it's heartening to hear that you and others are trying to make sure that there are these specific mechanisms for reporting back and different sorts of consequences that can occur if those savings and benefits aren't actually taking place. I do want to pick up on something you said that surprised me a little bit, and it's a way that I've never thought of this before, which is that it's actually the absence of RTOs and
Yeah.
potential balancing authorities. Obviously, we have some of that happening in the Southeast seam and otherwise, but not to the extent that we see in other regions of the United States. Actually, is a force for utility consolidation, because some would say, well, that consolidation is actually reducing consumer choice and reducing the ability of having sort of bespoke energy and electricity solutions for a smaller service territory.
Yep.
Whereas an RTO would arguably increase some choice if you had this kind of competitive landscape that people were bidding into. So that's a really, I think you're right. It's also somewhat paradoxical, right?
Yes. Yes.
That
Yes.
one is leading to the other. Can you say a little bit more about that?
Yeah, I think that when we see, when we look at the Southeast, the Southeast utilities have historically been absolute staunch opponents to wholesale market, expansion into the Southeast, the parts that don't have it. Um, and even to the extent where they, in my opinion, proposed SEAM as a way to, fight proposals of having actual markets enter into the Southeast. And so I think that the existence of, or the absence of wholesale markets, yes, probably makes it just a different sort of transaction when you're having mergers. I don't want to say that mergers aren't happening and consolidation isn't happening outside, of this vertically integrated space. But it definitely changes, sort of the benefit analysis that you can do because these are all, planned individually. I think there's also cases where, and I know we'll get into the NextEra Dominion one as well. Nothing in that proposal is to consolidate operations of these electric utilities. So they will still, Dominion Virginia, Dominion South Carolina, and Florida Power and Light will still operate completely separately. So you don't get those sorts of benefits that you do with the Duke, the DEC and DEP combination. So yeah, it kind of depends on the type of merger or combination. Whether you're getting those kind of benefits or are the benefits exclusively sort of the, more just on the business, corporate side and less the physics of the grid.
Right. Well, we're going to leave physics of the grid to somebody else. But thanks. And I do want to turn to NextEra and Dominion now. I will say though, just briefly, because we've been dropping an acronym without explaining it. SEAMS, the
Yes.
Southeast Exchange Market, a sort of RTO light system that has had very little uptake by volume in the region. There's a strong paper by the World Resources Institute that I recommend, that came out about 6 months ago, that unpacks the performance of SEAM and gives some recommendations on how it might be more effective. Apologies for not having the title there for our audience, but I hope that that's enough for you to be able to find it. I would recommend it to anyone who wants to know more. On the NextEra Dominion front, why do you think NextEra pursued Dominion? What does it tell us broadly about where the utility industry is headed? And within that, there's an interesting asymmetry here because NextEra is getting access to Dominion's high growth service territory. Dominion can get access to NextEra's balance sheet, proven record of build out of renewable infrastructure and otherwise. But as you say, we're not kind of getting that same efficiency gain that could happen through a more pronounced merger that brings everything under the same tent operationally. So from a ratepayer perspective, where do you see the potential disconnect between the benefits to shareholders and the benefits to customers?
Yeah, absolutely. It is a different situation, although um, certainly very impactful and interesting. So, yes, there are key differences between NextEra and Dominion that you mentioned, the balance sheet, the load growth, that sort of thing. NextEra already owns the largest regulated electric utility in the country in Florida Power and Light. So it's already huge. This will make it, even bigger. And so that means that the implications of any merger or purchase like this are big, and this is just even that much more impactful. It's also no secret that NextEra has been pursuing purchase of utilities. In fact, they had a pretty they failed to purchase South Carolina's state-owned utility, Santee Cooper, not too long ago. And now, Dominion obviously has a utility, a smaller utility, but one of the three main utilities in South Carolina. So we'll see how that goes for them at this point. Um, so yeah, the NextEra has also been pretty open about, that they are purchasing Dominion primarily to access this load growth. NextEra has a pretty successful um, track record in Florida with Florida Power and Light, um, of uh, of having, of building out generation and transmission there in a vertically integrated utility. They have a very, let's say, cozy relationship with the Public Service Commission down in Florida. They have a pretty good thing going. And from what I understand, NextEra thinks they can sort of copy paste that model from Florida into Virginia and South Carolina. I understand what they're trying to do. I just don't know that it's going to work out the way that they think it will. Especially Virginia, there's just a lot of differences between Florida and Virginia. Regulatory wise, the state, regulations are quite different. Dominion, Virginia is a part of PJM, where Florida is not. And the state sort of siting, permitting, all of those things are going to be very different. And so I think it's still a big question mark, that sort of playbook will work in Virginia and similarly South Carolina. So I think that's what they're trying to do, but I think it's uncertain whether or not it will work.
Yeah, you see growing pains potentially on the horizon, it sounds like.
Absolutely.
We have two questions. I'm going to put them together because they are closely related, and they both, unsurprisingly, are about the issue of the day, which is around how do we meet largely data center driven load growth challenges. The first question really focuses on baseload power, and the second question focuses on how this sort of consolidation that we're talking about affects the calculus around meeting that load growth. And I think that's where our discussion is probably most well placed to live. I think the way that the questioner puts it is quite apt. It's, does this concentrate risk and weaken the regulatory leverage states have? Or can this scale actually help tackle the demand crunch through the sorts of increasing efficiencies? And I recognize that that's not a yes or no mutually exclusive set of questions, that it can be both things in different contexts, but help our audience here understand the different considerations around those two scenarios.
Yeah, absolutely. I think you're right. It can be both or not. So yeah, I think this is absolutely the question of the day. I mean, utility regulators have a tough job in normal times, and with all of these factors going on, I think it's even more difficult. And I think that as to y'all's research as well, there are other key elements of competition that kind of factor in here, that can get somewhat, even more diluted based on these kinds of, mergers and consolidation. So, commissions tend to be, pretty, they have very tight budgets. They tend to have a lot less staff and resources than these utilities. And taking that even a step further, the regulators are the ones determining, is this, merger or, rate case or what have you in the public interest. Most, but not all of these states also have some sort of consumer advocate whose job it is to sort of bring that perspective of the ratepayer interest in, present it to the commission so they can decide. If commissions are understaffed and underfunded, I mean, the state commission, consumer advocates even more so. And so we have a real, David versus Goliath sort of situation going on. And with these, consolidation, Goliath's only getting more powerful, access to more resources, more funding, all of that. So in that sense, it does shift that balance of power. But I think that it's really clear too that the state commissions remain the regulators of those utilities in their state. So Dominion, Virginia is still going to be regulated in Virginia. Dominion, South Carolina is still regulated in South Carolina, et cetera. And so it makes it even more important for those commissions to take a really hard look at each of these cases. I think the other piece that is a big risk right now is that this combination of consolidation and the load growth forecasts means that the utilities are asking commissions to go faster and faster. And that obviously is a risk of, not getting as deep of a look as we need to. The commissions are making decisions that will impact ratepayers for decades, and it needs to be given the time that it deserves, for such a magnitude of a decision.
Yeah, thanks, Maggie. That's a really succinct and useful way of describing that capacity and information asymmetry that I referenced vaguely earlier. And as the Goliaths get bigger and bigger, maybe one final thought from you.
Yeah.
We have lots of folks in the audience that are not sitting commissioners, if you can believe it. So, what can some organizations like our own, like others, do to help to promote positive outcomes for the power system and for customers moving forward in this context of regional and ultimately growing national utility consolidation?
Yeah, great question. I think because most of these are happening at the state level, unless you have a municipal or co-op utility. So getting involved at the state level, going and checking out the tool that y'all have put out, and seeing does my state have a consumer advocate? Is my commission, how are my commissioners chosen, that sort of thing. So being informed and then getting involved. And getting involved can mean going to speak at your commission. A lot of these have public hearings for key decisions. Some states even you can vote for commissioners. Some states, it's something that's mostly dealt with by the governor or the legislature. So reaching out to those representatives. And then a step further is what SACE does, which we intervene in these dockets. And so look for organizations. We're a member organization, so you can join organizations that intervene and sort of help drive that process so that we can present a case to the commission, or other organizations can present a case to the commission on how to best make these decisions to to the most to the public interest, to the ratepayers' interest, all of that. Because if we're all combining our resources, we can be a little bit of a better match towards those Goliaths.
Thanks much, Maggie. Really appreciate you spending the time to offer your insights for us here this morning. If I may crudely summarize, it's that these efficiency gains that are being promoted and espoused are real, and that they are materially significant, and they can help solve some major grid challenges. And ultimately, efficiencies can lead to cost savings for all sorts of customers, from the residential to the commercial and industrial and beyond. However, accountability is key. And we should not just assume on face value that those savings and efficiencies are always realized, and that it's incumbent on observers and commenters in the power system, researchers who can offer evidence to help support the vetting of those outcomes, as well as the regulators themselves who are charged with ensuring that they take place, to be very diligent in this regard. I think that's an excellent segue to my colleague, Ben Weintraut. He joined Duke in early 2025 after a stint at the White House Council of Economic Advisors. We're going to move back in time here a bit, and Ben is going to pick up in many ways where Maggie left off to talk about the economics of electric utility mergers and what we can learn from the past. Over to you, Ben.
Classic. Forgot to unmute. So yeah, what I'd like to do is give an economist perspective on electric utility mergers. So I'll start off with some key principles and highlights from the empirical literature that I think are most relevant to the current discourse. And then I'll wrap up with some of my own research and some policy recommendations. Okay. So from an economic perspective, mergers involve a classic trade-off between potential efficiency gains and the adverse effects of market power. And this trade-off applies both to regulated and deregulated markets, but it's worth noting that in regulated markets under cost of service regulation, any efficiency gains need not translate to lower retail bills. So savings can be retained until the next rate case, capitalized into the rate base, or reallocated across customer groups. And when we think about how to evaluate mergers, it's worth keeping in mind that any realized efficiency gains are inherently difficult for regulators to verify. And kind of the fundamental reason here is that any savings or efficiency gains depend on an unobserved counterfactual. And that's what would the costs have been had the merger not taken place. So I'm going to move to providing some key highlights from the empirical literature, so what researchers have found working with real world data. So the first is that bigger does not always mean cheaper. So economies of scale do exist in the electric utility sector, but they're concentrated at smaller firm sizes. So firms the size of a Duke Energy and Dominion, for example, there's likely limited ability to have increased efficiencies from increased size alone. The second is that projected savings have been hard to find in retrospective studies. So a study by Kwaka and Pollitt find little evidence that mergers led to improved distribution costs in the restructuring era. Third is that value generated for the firm does not always equate value for customers. So evidence from the restructuring era suggests that firm level or plant level efficiency gains do not automatically translate into lower retail prices. And then finally here, efficiency gains typically require a real change in plant ownership. So it's the operational control of the firm changing, not just a parent company owner changing hands. These last 2 points motivate some research I've been working on, which explores the price effects of mergers among affiliated electric utilities. So affiliated mergers involve utilities that already have common ownership. So where management, planning, procurement, and often joint dispatch are already in place beforehand. So we can think about the current or upcoming Duke Energy Progress and Carolinas merger as an example of this. They're both owned by Duke Energy Corporation. So in these kinds of cases, they're useful in a way for research purposes because the scope of potential changes is relatively limited compared to conventional mergers. So the research question I ask is, when affiliated utilities consolidate, do customers receive the savings claimed during merger review? I'm going to focus on 3 historical case studies. There's several others on the historical record that I don't include either because they were too recent to have a meaningful post-merger period. They took place during the restructuring era when lots of other stuff was going on, or they were relatively small in scope. So the 3 I'm going to focus on are AEP Ohio, which combined Columbus Southern Power and Ohio Power in 2011, a merger between Energy Louisiana and Energy Gulf States, Louisiana in 2015, and a merger between Florida Power and Light and Gulf Power in 2021. The final column on this table shows savings claims that were made by these utilities before the mergers took place. So AEP Ohio claimed there would be no impact on customers' rates. Energy Louisiana claimed up to $140 million in benefits, and Florida Power and Light claimed that the merger would yield increasingly more affordable bills and $2.8 billion over the asset's lifetime. So how do I evaluate these case studies? So my research design is deliberately pretty simple and transparent. So I'm going to focus on one outcome that's policy relevant, which is average residential price. This is sourced from the Energy Information Administration's EIA 861M survey. And for each merger, I'm going to compare the price series or price history for the merged utility against two benchmarks. The first benchmark is going to be, is going to be a sales weighted average of other investor-owned utilities in the same state. So this kind of captures factors that are common within the merged utility state, including demand conditions, fuel cost conditions, weather, and the regulatory environment. Second, I'm going to compare the merged utility to a synthetic control. This is a weighted blend of utilities in the same and neighboring states that's statistically optimized to track the merged utilities pre-merger price path. So the idea here is that we build a comparison group that moves very closely with the merged utility in the pre-merger period, and then test whether and how the merged utility diverges from the synthetic control in the post-merger period. Just to be concrete, my objective here is not to estimate directly the savings, the direct effects of these mergers. And as I'll get to later, the publicly available data I'm working with actually can't reliably answer that question. Rather, what I'll do is assess whether these residential prices moves in a direction that's consistent with or not consistent with the customer savings claims made by the utilities. So I'll get to the first set of results here. So I'll walk through this one kind of slowly. So the y-axis here is the average residential price. The vertical line is the effective date of the merger for AEP Ohio. And this black line represents the to-be merged entities combined in the pre-merger periods. This was Ohio Power and Columbus Southern. And in the post-merger period, they report as one entity, AEP Ohio. So we see that the prices were trending upward throughout the pre-merger period into the post-merger period, and then kind of leveled off around 2015. So how do we read that? That could be fuel costs or other factors outside the utility's control driving the increase, and that's what the comparison groups are for. So the orange line here is other investor-owned utilities in Ohio. So we see that relative to them, AEP went from having generally lower prices in the pre-merger period to higher after. So you might say the merger raised prices, but that might not have been on the same trend to begin with. And that's exactly what the synthetic control fixes. So the blue line tracks AEP's merger path by construction, so a divergence afterward is hard to dismiss as a pre-existing difference. And against that, AEP's prices also clearly rose. So, and I'll be careful here, this is descriptive and not causal. This is fairly strong evidence that the AEP merger was associated with price increases, which contrasts sharply with the claim that there was no impact on customers' rates. Okay, moving on to the Energy Louisiana case. So if you look at this, the picture is basically just less clear than the AEP Ohio case. If anything, both benchmarks moved favorably in energy's direction. So the black line sits below the orange or blue lines throughout the post-merger period. So here my takeaway is that the Energy Louisiana, it's reasonable to conclude that there were some customer savings or price decreases. And then finally, in the Florida Power and Light case, here we see that there's the Florida Power and Light black line very closely mirrors trends in the orange and blue curves, the two comparison groups. So my read is that there's really no definitive impact, and the conclusion depends somewhat on which benchmark you use. This table is going to summarize the mixed results that we saw in the previous figures. So this shows the mean gap between the merged utility and the two benchmarks in the pre-merger period and the post-merger period, and then the change between these two periods. And this just kind of reinforces or puts in the numbers the mixed results we see. So in AP Ohio, relative to both benchmarks, we see a price increase. For energy, Louisiana, for both benchmarks, we see a price decrease. And for Florida and Power Light, we get mixed results depending on which benchmark we use. I wanted to note real quickly kind of a limitation of the publicly available data we have through EIA. And that's specifically relevant when evaluating these kind of savings claims. So if we take the savings claims, for example, for Florida Power and Light, and we spread that over the years of the savings claim as well as the whole rate base, they come out to fractions of a cent per kilowatt hour. And what that means is that the savings are an order or two of magnitude below what we can actually observe in terms of the variation in the publicly available data. So the implication here is that with publicly available data alone, we can flag large adverse price movements like in the AEP Ohio case, but we can't verify that promised savings were delivered. And that's why savings tracking and disaggregated reporting are important. Okay, so this brings me to some of my policy recommendations from my perspective. The first is that we should presume neither savings nor harm. The evidence supports neither by default. Second, we should make merger claims publicly and independently verifiable. That includes requiring explicit counterfactual baselines agreed upon in advance, preserving disaggregated reporting for legacy territories, and reporting firm-level efficiency changes and customer bill impact separately. Third is to require post-merger review. So regulators scrutinize promised savings before approval, but systematic independent review of whether savings actually materialize is far less common. And then fourth is to ensure savings actually reach households. So pass-through, as I mentioned in the first slide, is not automatic under cost of service regulation. And just to conclude here's kind of my takeaway points. The first is that theory and empirical evidence call for caution. So mergers can generate efficiencies, but empirical evidence shows that gains are uncertain and do not automatically reach customers. That concern is sharper for affiliated utility mergers when common ownership already exists. The historical evidence that I showed on the price effects of affiliated mergers is mixed. So the policy lesson here, in my opinion, is accountability. So claims should be tied to clear baselines, transparent tracking, disaggregated reporting, post-merger review, and pass-through verified savings. So in summary, we should presume neither savings nor harm, but we should ensure that the difference be publicly and independently testable. Thanks. I'll turn it back over to you, Jackson.
Thanks much, Ben. Excellent work here, and appreciate your time so succinctly presenting it to us all. I'm going to ask you just one quick question, and I hope that it's not too tedious, because you certainly attempted to answer this in many ways in your conclusion there. But can you go a little bit deeper on your recommendations about what is needed? You've talked about the processes and sort of systems of checks and balances that need to be put in place to ensure accountability. As someone who's just gone through this exercise of trying to attain the necessary data to make these judgments about these outcomes, what on the data front is absent from your perspective? What could improve the information needed to actually carry out some of the recommendations that you offer there?
Yeah, so I think something that Maggie brought up earlier as well, but this starts, I think, also with the fact that the kind of regulatory bodies that help to verify these savings claims, so utility commissions and public sanctioned consumer advocacy groups like Public Staff in North Carolina, are kind of by nature constrained in their ability and their staffing to conduct these types of reviews. They're always super busy. There's definitely a plethora of researchers like myself out there that would love to dig into the data to provide more analysis onto whether these kind of claims bear out. Really, I think it comes down to disaggregated reporting would be really, really beneficial from a research standpoint. So currently in the EIA data, the most granular data we really get in terms of sales and revenue is at the utility, state, and sector levels at the monthly level. So I think at the bare minimum, reporting, so for mergers in particular, reporting, continuing to report data at the legacy service territory level. For example, for Duke Energy's upcoming merger, that would be continuing to report at the current progress in Carolina's service territories at bare minimum would be useful. I would love to see data that's much more granular than that. So just at the county level, I think there is pushback against that because of confidentiality reasons, which I understand more for the commercial and industrial sectors where public data, where large users, you might be able to back out who those large users were and what their consumption patterns are. But with so many consumers at the residential level in any given county, for example, I am less convinced that confidentiality is a true barrier on that front.
Yeah, thanks much, Ben. Appreciate that clarification and expansion of your thinking there. Look forward to seeing what you continue to produce on this topic. I'm soon to hand over to my colleagues, Trey Gowdy, who's a senior policy researcher, and Eric Parajon, who's a senior policy analyst here at the Nicholas Institute, to update us on some of the expansions to our Southeast Power Sector Competitiveness Dashboard that we have undertaken since we last presented on it. I will just say one comment that Eric and Trey are likely to not get to because it's still a gleam in our eye rather than an actual expansion of the dashboard, but that is very much related to the conversation we've been having over the last 40 minutes. And that is to be able to provide more analyses and information about the capacities of utility commissions and public staffs in different states. There's real variability on this, and the dashboard makes an initial effort at providing some of that information in terms of how utility commissions are selected, and governed. But there's relatively little information on the dashboard, or from our estimation elsewhere out in the information landscape, about specific capacities. And that's really vital for understanding when we're thinking about these challenges of accountability and ensuring positive outcomes for power sector users across the whole value chain. So that is likely to be coming. But rather than tell you what our aspirations are, I want to hand over to Trey and Eric to give a sense of some of the recent additions that we've made and how they relate to these issues of mergers and acquisitions. So Trey, over to you.
Thank you, Jackson. Appreciate it, and excited to share a little bit about our power sector competitiveness dashboard and some of the new resources that we've added since launching in December. So just by way of introduction, if you're not familiar with our power sector competitiveness dashboard, or if you've used it since we launched in December of last year, we're happy to share that we have some additional resources to this dashboard. The dashboard explores 15 indicators, which are shown here on the screen, primarily policies, but also key aspects of the structure and landscape of the power sector in the Southeast across 12 states. And what the dashboard shows is provides common evaluations across each of these indicators across the states, and allows for rankings of the states across these competitiveness indicators, both a combined ranking across all 15 indicators, but also the ability to dive into specific categories, which we provide here. There's the consumer category, the structure category, and the regional market category. And these are constructed with the idea being that as you go from the top to the bottom of this list, they are theoretically more transformative across these, but we recognize that there is some blurriness across the category types and across the indicators of terms of the impact there. But we want to highlight at least that general background on the dashboard. Two of the new resources that we would like to highlight are we have a new simulator tool on the dashboard. So we've provided rankings and a methodology for how to analyze the different scores across the different states. But if you are interested in reweighting some of the components of the methodology, that function is now available. Whereas if you want to, for example, provide a heavier weight to the consumer category or certain indicators, that is something that you can now do to provide your own sense of what the impacts of those different policies or categories are and see how that may change the ranking depending on your custom level of interest and particular corners of this continuum. The second item that I want to highlight here is we have also added specific tables that are also in a report that we'll reference later, clearly highlighting not just the numerical scores across these indicators, but also the specific policies in one single place to compare across states. And so that is now available on the dashboard. And invite you as you log off today to explore our dashboard. Easy short URL. It's at duke.is/sepower. Also want to highlight another resource that we have here on the dashboard that I want to give a little bit additional detail to is around generation capacity concentration. This is an indicator that we have on the dashboard and was part of our initial launch, but what we've done is provided not only a view of data for the Southeast, but all 50 states, and provided a specific page to look at some of the data in a more combined view. And I think the key takeaway for this page is looking at the generation concentration of utility scale generation. And this is really a way to view as a common measure of market concentration on a scale of 0 to 10,000, with a state score less than 1,000 being considered less concentrated, a score between 1,000 and 1,800 considered moderately concentrated, and this common metric score over 1,800 up to 10,000 is considered highly concentrated. And we can see in the Southeast, for example, unsurprisingly, these are states where generation capacity tends to be highly concentrated, and there are other pockets like this around the country. But in general, the Southeast does tend to have higher generation concentration, more so than other parts of the country and as a national average. So with that, I'm going to turn it over to my colleague, Eric Parajon, and we will dig into some more exciting resources new on the site.
Thanks, Trey. Yeah, so one of the kind of products that we're particularly proud of that's obviously relevant to this conversation today actually came out of this data that Trey was just talking about, this generation concentration data. And kind of building on the earlier discussion about the Duke Energy merger, what we were interested in is looking at, okay, we have this kind of measure of concentration. How would this merger impact it in states where Duke Energy is active, so North and South Carolina, and so what we did there is we looked at how the data would change as we if the merger were to go through, and conducted a bit of counterfactual analysis that's on the next slide here. And what we found is as it should come of no surprise, that these kind of affiliated mergers can impact concentration. And what we're showing on this slide is two different measures of concentration. So one is retail sales concentration, and the other is generation capacity concentration at the bottom of that figure. And what we're showing is out of the 50 states plus Washington, D.C., state ranks. So both a pre-merger rank on kind of the left-hand side of the slide, a post-merger rank. Again, using kind of this counterfactual approach of like, okay, what would the data for 2024 that comes from the EIA look like if this merger were to happen? So kind of speculating ahead a little bit here, and what we see is pretty kind of significant impacts using this concentration measure. So we see that North Carolina, for example, would shift 20 places in terms of state retail concentration rankings, and 10 places in terms of generation capacity concentration. Which you can also see from the slide is fairly significant state heterogeneity. So there's kind of a high degree of variation between neighboring states, even though both North and South Carolina are primarily vertically integrated utility states. That these kind of concentration, both pre-merger and post-merger, is pretty significantly different from the two states. And so I think kind of our takeaway from this graphic here is, one, it highlights the importance of conducting really rigorous state-by-state analysis. So instead of kind of just grouping North and South Carolina together and being like, okay, these are both kind of Duke Energy territories, let's get a combined rankings. By disaggregating it, I think you get kind of a more complete and potentially interesting picture of what the underlying data would actually look like. And two, I think it really kind of potentially highlights that that these kind of mergers have a possibility of heightening the effects of both Duke Energy decisions and rate case decisions in both North and South Carolina. And I think to some extent gets this kind of David and Goliath dynamics that Maggie was mentioning earlier. And this is something that we've explored a bit in a paper that we released recently that we're quite proud of, as kind of another product that's coming out of the dashboard. So in encouraging and impeding power sector competitiveness, we really kind of took the Southeast and started to look at it. So as Maggie and Jackson discussed at the beginning of this conversation, the Southeast is known as this kind of primarily non-RTO region, often seen as kind of a region of limited competitiveness. And so what we wanted to do in this paper is really to interrogate that and kind of investigate what kind of the regional competitiveness landscape looks like on this kind of state-by-state basis for the Southeast. So we highlight case studies, we summarize an array of evidence-based benefits of power sector competitiveness across this kind of continuum of policies that Trey mentioned, from kind of more consumer-facing opportunities like utility green tariffs to kind of bigger structural options to seek to realign utility incentives to potentially better address challenges in the Southeast, such as affordability, without requiring major changes to the region's existing systems. And one of the components of the paper that I think dovetails quite nicely with our earlier conversation is this idea that high concentration, so a sort of a large share of generation capacity or a large share of retail sales going to kind of a couple small utilities per state, really to us kind of indicates limited competitiveness, limited competition. And I think to some extent can kind of magnify what we see as some structural challenges in kind of the regulated power sector in states. And so what we find in the paper is that these factors such as capital bias cost recovery or even kind of traditional cost of service regulation overall can potentially incentivize utility decision-making to favor kind of more capital-intensive investments over operational or market-based alternatives. This is what's known in the literature as the Average-Johnson effect. And one example of this would be kind of an incentive to potentially spend on traditional transmission rather than improving existing grid capacity. And so what we discuss in the paper using some of this concentration data that we just presented is that a competitive market, you can think of kind of entry of rival firms could potentially help push a utility towards kind of cost minimization, regardless of whatever the regulatory formula that they're presented. And so a kind of more highly concentrated market like what we're dealing with in the Southeast has relatively limited competitive substitutes to kind of affect decision making. And we know from related work that Ben has done that there's been quite limited entry of new firms in these regulated markets, in these regulated states. And so we argue in the paper, this idea of realigning utility incentives can help kind of overcome structural impediments to competitiveness in the region. And there's kind of a plethora of options that we discuss in the paper. Don't have time for that now, but one I did want to highlight is the idea of performance-based regulation that I think has kind of been picked up in pilots in places like North Carolina and Virginia, as well as kind of other states like Hawaii or New York. And what PBR, or performance-based regulation, does is it connects kind of achievements of objectives such as affordability, residential affordability, high reliability, or even emissions reductions to utility financial performance using these kind of incentive mechanisms and metrics. And what this can kind of do is it can break somewhat this kind of link between profit and capital investment that drives these kind of potential capital biases that I just spoke about, and gives the utility a financial incentive to control costs, even in these kind of lower competitiveness, more highly concentrated states. And crucially for the discussion today, I think mergers are one place where state utility commissions and consumer advocates can really leverage the kind of approval of the merger or acquisition to get performance-based regulation pilots or other kind of consumer-friendly products in place, or even to encourage the kind of data transparency that Ben had just discussed earlier. So definitely encourage you all to check out the paper and kind of the related dashboard products. And I'll turn it back over to you, Jackson.
Thanks, Eric. Thank you, Trey. And please, to our audience, we're always looking for ways to improve the dashboard. So if any of you do spend any time on there and have ideas of how we can make that tool more useful for your own or others' purposes, do not hesitate to reach out to us. We're all quite easy to find. We have 3 minutes remaining. I'm going to chime in briefly about the most recent question from an attendee about the likelihood that a mechanism like a dedicated tariff or upfront cost contributions have political viability in North Carolina, a state with a low tax burden and business-friendly outlook. I'm also going to ask Ben to chime in here on the question about post-merger mechanisms vis-a-vis the post-merger record on transmission. My answer to the question on these sorts of approaches and tariffs in North Carolina specifically is yes. I think that there's every expectation that we will see a specific large load tariff that seeks to address the challenges wrought by load growth and specifically data center driven load growth. There's evidence out of the Attorney General's office that is in the offing. That is a recommendation of the State Energy Task Force, which is currently at work in helping to construct that large load tariff. There will be a review and public comment period for that tariff itself. And so I think that there's ample evidence that there's some political will to ensure that the imperative of attracting business and utilizing the fact that North Carolina is an attractive place from an energy perspective in many ways does not lead to the socialization of costs for new energy across the entire rate base that can come from that. And there's also a willingness to pay in many instances from the drivers of the load growth that can be pursued readily if it helps them to achieve their goals for speed to power. So I'm bullish on that particular question. Ben, do you want to chime in at all on the transmission question, just briefly here before we wrap up?
Yeah, I responded to the chat, but yeah, we looked a bit into data that exists, transmission investments. Unfortunately, this is definitely worth us looking at in more depth or taking a second stab at, because the question raised in the chat was really interesting. But from my understanding with what we looked at initially is that basically the transmission investment data is just much more patchy, less comprehensive, really hard to nail down timing and actors at play in the transmission projects, especially relative to the price data. So that's why I focused on the price data and the analysis I did. But yeah, it's certainly worth us taking a second look at. Thanks,
Ben. We're at time, but Maggie, I want to give you the final word. There's an interesting back and forth in the chat on FERC's independence and FERC's role in this whole ecosystem of mergers, acquisitions, jurisdiction that we've been talking about. Can you just give us 1 minute or so to unpack that?
Yes, what a thing to leave on. So yes, so there was a recent Supreme Court decision that obviously changes the sort of independentness of independent agencies, federal agencies. We have yet to see if or how that might impact FERC. Historically, it's been easier for mergers to get approved federally than at states. I won't say it's easy or hard on either one necessarily. It kind of depends. And so I think I think the change in this, how independent FERC can or will be from various administrations will be a potential factor in moving forward on FERC's approval of these mergers and acquisitions. And we don't know, how that's going to play out exactly.
Okay, thank you, Maggie, for that and for your insightful thoughts earlier. Thank you to Ben, to Trey, and to Eric for presenting your most recent findings. Thank you to all of the participants for spending an hour with us. We look forward to next time. All the best.